This is Chapter 16, Section 3, Monetary Policy. As we are going through the information today, I recommend that you take notes for your check for understanding at the end of the lesson, as well as for your unit test. So before we get into the lesson, we need to define monetary policy. And monetary policy includes the Federal Reserve's actions that change the money supply in order to influence the economy. And if you remember back to when we first introduced the Federal Reserve, one of the things that they do is they put money into the economy and they can take money out. So there are three actions the Federal Reserve can take to manage the supply of money. Balancing the supply of money is very important. Remember that they are constantly trying to keep inflation low, but not so low that it makes money too valuable and difficult to come by. So they have to really find that balance. And there are three ways in which they can do that. The first is open market operations. The second is adjusting the reserve requirement. And the third is adjusting the discount rate. And we'll take a moment to talk about each of these. These actions can be taken individually or in combination with one another. So usually the Federal Reserve is looking at what is happening within the business cycle, and they are going to have to make decisions based on that. Now, they may try one of these strategies, and if it is effective, then they won't need to use a different strategy. But if it's just somewhat effective, then they may do that in conjunction with one of the other actions as well. So the first action that they could take is called open market operations. This is the sales and purchase of federal government securities. This is the tool most used by the Federal Reserve to adjust money supply. It expands money supply by buying government securities, and that just means they buy bonds from banks or write checks on itself. This allows banks to lend excess reserves. So by buying bonds from banks, they basically are giving money to banks for those loans, and so putting money into the actual economy. They can also contract money supply through this action by selling government bonds, and when they sell these pieces of paper, the bank in turn will give them money for the bonds, and then the Federal Reserve takes that money out of the market. So funds to purchase bonds are taken out of circulation. Federal funds rate, this is the interest rate that banks charge one another to borrow money. And the Federal Reserve really is the one that adjusts the FFR, or the federal funds rate. So the Federal Reserve lowers target for federal funds rates and buys bonds, or they will raise the target for the FFR and sells bonds. So if you think about it, when we talked about bonds, remember that a bond is a loan. So if the government is buying loans from somebody, then that means that they're in turn giving cash to whomever they're buying it from. And so that would put cash back in circulation. And the opposite then would apply for this contraction of money supply. When they decide to sell the bonds, the bank or whomever is buying the bonds then is handing over the cash, and the cash goes to the Federal Reserve and is taken out of circulation. Action 2 is adjusting the reserve requirement. So the Federal Reserve sets the required reserve ratio, called the RRR, for all depository institutions. Remember, a depository institution in this sense is usually like referring to a bank. So the RRR affects the money supply through the deposit multiplier formula. An increase in the required reserve ratio can reduce money supply, and a decrease in it can expand money supply. So let's talk about what this really means. Banks are required, if they hold money for anybody, to have a certain amount of money on hand. So they have to have some money in reserve that they can have just in case. And so if the Federal Reserve tells banks, hey, you need to increase this amount of money that you have on hand, then that takes away from the money that the bank has access to give out. So that would reduce the amount of money in circulation. And the opposite holds true. If the Federal Reserve says, hey, you don't have to have so much in reserve, you can give this money away, then that puts that money back into circulation and would expand the money supply. The third action, adjusting the discount rate. The discount rate is the interest rate that the Federal Reserve charges when it lends money to other banks. So the Federal Reserve is the one that is typically the lender for banks, and they're going to set the reserves that banks have available to lend. So if the Federal Reserve increases the discount rate, banks borrow less because they aren't, able to purchase as much, and so therefore the money supply decreases. If the Federal Reserve decreases the discount rate, then banks tend to borrow more, and there's more money supply in the market. So we're increasing what money is in circulation. Okay. So when thinking about this, you kind of have to think about it as far as just regular interest rates, right? When interest rates increase, people tend to borrow less, and banks are no different. So if they know that they're going to have to pay more in interest, why would they want to borrow more money? So they're going to typically borrow less, which would decrease the money supply. And the same thing if you see that the discount rate, also known as an interest rate, decreases, banks are ready to get out there and borrow more money, which then would put money supply increase the money supply. Okay, so prime rate is the interest rate that banks charge their best customers. These are going to be their most loyal customers. These are going to be their customers that probably have the best credit. And this discount rate that the bank receives is going to affect how much the banks can charge their customers for interest rates. So if a bank is having to spend more money for a loan with higher interest rates, chances are the interest rates for their customers are also going to increase. If a bank doesn't have to pay quite as much interest for their loans, then they're also going to be able to charge less for their customers. Okay, so there are a couple different approaches to monetary policy, and the purpose of monetary policy is to curb inflation and reduce economic stagnation or a recession. So the Federal Reserve is really there to try to protect the economy, promote full employment and growth, prevent rapid increases in prices or high interest rates. So they're there to kind of help level out the market, make sure it's successful, but still it does allow for the economy to go through these business cycles. So there is the acknowledgement that we will still have kind of these ups and downs, but maybe making those highs and lows less dramatic as they could be without being checked. So the two policies are expansionary monetary policy and contractionary monetary policy. In expansionary policy, this is usually used during a slowdown in economic activity. So the Federal Reserve may step in if we are at that trough level of the business cycle to try to get things moving again. And sometimes this is also called the easy money policy. It puts more money into circulation by making it easier for borrowers to secure a loan. So they're going to do whatever they need to do to try to bring those interest rates down. The Federal Reserve will buy bonds on the open market. Remember that by buying bonds from banks, they're putting money into circulation. They're going to try to decrease the reserve requirements. So they're going to tell banks they don't have to have as much money kind of in reserve, that they can put it out there for customers. They're going to decrease discount rates, which are those interest rates for banks. Or they may use a combination of these. So these are not all mutually exclusive. You can combine them. But they must all be used in moderation to avoid inflation. So we want to see growth, but we can't see too much growth too quickly, or else we get this inflation where our money loses its value. Contractionary policy is the opposite. It's used when the economy is expanding too quickly. So usually we'll see this kind of as we're expanding, but really when we hit what we would hope would be that peak of the business cycle. This is also called tight money policy. So they're trying to rein that money back in, get the economy back under control. So this is designed to reduce inflation by making it more difficult to get loans and decrease the money supply. So some actions the Federal Reserve might take are things like selling bonds on the market, on the open market. So remember that they would sell these documents, these loans, and people would pay money and the cash would then be taken out of circulation. Or they could increase reserve requirements, requiring banks to keep more money in reserve, which would take that money out of circulation again. Or they could increase the discount rate, so they're going to increase those interest rates that they charge banks. Or again, they could use a combination of these. Again, you have to, use these in moderation. You can't do things too quickly because you have to allow the market to respond before you take that next step. You don't want to do too much too quickly. So what are the impacts and limitations of monetary policy? So you have to ask yourself, how successful is the Federal Reserve on implementing monetary policy? So the first thing they could do that would be a short-term effect is a change in the price of credit quickly. So they can easily change interest rates on loans, and that would definitely have an effect on the overall economy, and that would have a pretty quick response. Unfortunately, though, a lot of things that happen within our federal government definitely take time, and we don't see the effects of them until much later. So policy lags. The Federal Reserve must wait for specific information and statistics before they can respond. So we've talked about this before, things like unemployment. You don't know what unemployment is until at least a month later. And so other things like that take time for us to collect the data and see where things stand. So it can take up to 2 years for adjustments in monetary policy to take full effect. So, adjustments that may be happening now, we may not see the results of for another 2 years. Timing issues. Monetary policy must be coordinated with the business cycle in order to provide a stable economic environment. So that's why it's important that we have economists who are constantly looking at the data, seeing where we are in the business cycle to make these decisions. It is possible to make decisions too quickly, and then you end up with economic turmoil. Other issues, goals of the Federal Reserve can clash with Congress or the president. It's supposed to be nonpartisan, so the head of the Federal Reserve serves for 14 years. But again, it can't be completely nonpartisan because the head of the Federal Reserve is appointed by the president and confirmed by the Senate.